pressure.
Yeah, and that's exactly why that lending product exists.
Yeah.
Or that feature exists, is the bridging loan, because the banks know and the companies that lend money do know that this is a problem that people experience, and they've offered a product that allows people to do it. The challenge associated with it, and using some of the terminology, is you need to be able to service.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again.
Andrew, we are back again. And this is a really stuff that up completely. This is a really topical episode that we're going to talk to everybody about today, because we were just sort of talking about property, right? As we tend to do.
Yep, that just seems like a daily occurrence to us, right? So it could have been any day.
This is true. But what we're talking to people about today is managing the upsizing of your family home. So what does that look like? What are some of the things that we should consider? How do we fund it? Do we buy first? Do we sell first? Do we do this? Do we do that? Whole heap of things to think about. Pros, cons, emotions, finances, headaches, other people's opinion, you name it. So, Andrew, what do we do? Where do we start?
Look, in this scenario, we're talking about upsizing. And this is fairly common for us in our business. We tend to see, a lot of our clients are wealth accumulators. They're growing their wealth, and naturally, as their wealth gets to a certain point in time, they say, you know what, the house that I live in deserves to be, bigger, grander, in a nicer area, whatever it is. And so you then come to the dilemma of, okay, I understand conceptually how to do it, right? Like, I understand that starting position is X, ending position is Y. Debt position is usually higher on Y than it is on X. But what do I do in that middle section? Like, how does that actually happen? And what are the options? And when you think about it, I guess traditionally or mechanistically, you're kind of caught between two really difficult dilemmas. The first is, do I sell my existing property first and try and sell that property with the longest settlement term possible, which then affords me the ability to hopefully buy and secure a property by the time, I settle on the sale? Or do I buy my new property and buy it on the longest possible settlement term and try and sell my property really quickly in between? And then I've got this really difficult dilemma whereby, oh no, if I'm not getting the offers that I want, what do I do? Do I have to sell for a lower price? And, does that mean that my financing is no longer going to work out, or am I just accepting an offer that I'm not necessarily happy with? It's a very, very difficult conundrum when you're faced with those two options, and there's kind of no right answer.
There's no right answer. Whatever you end up doing, you feel pressure from somewhere. So as an example, if you buy first, then you're under pressure to sell and potentially take the price that you're going to get.
Yep.
And hoping that you can get, in terms of the property that you buy, a longer settlement, and the place that you sell a shorter settlement. You're not going to be able to get them, very, very rarely, I should say, are you going to be able to get them to settle on the same day. There's a whole range of different issues associated with that too. But no matter what you do, you're going to experience pressure. Or let's turn around and say, hey, we're going to sell first. We're going to see how much that we get. Then what we're going to do is we're going to buy afterwards. But hang on a sec, if we do that, there's going to be a gap in time between when we sell and when we move into the new hypothetical place. So where do we live? Where do we store all of our stuff? Do we rent for a year? Oh, geez. Okay, then there's an issue because we're out of the market for a year. Plus, we've just incurred, at least contractually, 1 year worth of rent, assuming it's a 12-month lease. So no matter which way you go, you tend to, experience pressure. And it's a combination of which pressure do you feel more comfortable assuming in terms of which way you go forward. from my perspective, what I tend to do from an advice point of view, if it's just black and white between those two differences, and we might talk about some alternatives and stuff, I always tend to err on the side of caution that you sell the asset first before you buy, because at least that way you know what you're looking at. In saying that, it does come with other challenges as well, time out of the market and so on and so forth. But it is such a difficult thing and there is no right answer.
Yeah, and when you're looking at it, I mean, you need to balance out, one, the cost, because there's a cost on it. And the cost of what I mean by that is, okay, let's assume that there isn't a physically incurred cost, at least when you're talking about housing. So say, okay, I'm going to sell my property first. I'm going to move in with mom and dad, and it is what it is, and we know that might be a challenge, but we're going to do that for X period of time until we buy and move into the new place. But there's also some costs that get incurred over that process. Maybe there's moving costs. Maybe there's, changing all of your gas, electricity, and, needing to turn that off, turn that back on, and new service providers and additional costs that are associated with all of that stuff. But there's also the emotional cost, and moving is never an easy process. And so when you're balancing all of this, there's the, okay, great, we need to make sure that, yep, this is the right, tick box financially. We also need to consider that moving twice is twice as difficult as moving once. And so, a lot of the times what people will consider is things like the bridging loan, something that covers that interim period in order to be able to say, okay, I need some bandwidth on either side of that window. And, can we do it through a bridging loan? Or, one of the other considerations is, if you can afford it, being able to take equity out of the old place, use that as a deposit on the new place, and maintain both properties, knowing that, okay, yes, there's going to be two lots of mortgages with no income coming in. What's the run rate of that? Can we afford it? To be able to then allow us to move, settle, and sell the other place without having that same level of time pressure.
Yeah, and that's exactly why that lending product exists.
Yeah.
Or that feature exists, is the bridging loan, because the banks know and the companies that lend money do know that this is a problem that people experience, and they've offered a product that allows people to do it. The challenge associated with it, and using some of the terminology, is you need to be able to service the peak debt position. So at a point in time, when you've got both sets of mortgages on those properties, what does that then look like from that perspective? There are some things that you can look at in terms of capitalizing the interest. So you'll pay interest, but rather than paying it from cash flow, it'll just get added to the amount of debt that you have got, with the idea that when you sell your original owner-occupier, it'll wipe out all of the debt and get rid of the bridging loan. You'll still have a mortgage on the new place. That definitely is there. In saying that, and the trade-off associated with it is more expensive, and you need more financial capacity in order to get access to a lending product from that perspective. Probably the best scenario that I've seen is probably two things, just thinking about different solutions and things like that. If somebody's in a position where they've made the decision to convert their owner-occupier into an investment, from a timing perspective, it buys you more time. Yep. So you can move your stuff, buy the place, move your stuff once, clean up the existing place, get it ready for rent, and away you go. The trade-off associated with that is that you've got multiple, I guess, mortgages, if you've got a mortgage on the existing one, but you've got multiple mortgages, and you're losing time before you get the income stream on the original owner-occupier. Or the other way to do it is, if you're selling your existing property, you sell that first, then you buy something, and there's a gap between settlement. If you're fortunate enough to be able to move in with family, that reduces the cost and the time frame associated with, say, taking a traditional lease. But the problem is where do you put your stuff? And look, putting it into storage is no doubt going to be cheaper than taking a lease for 12 months. Or is it a good idea to be able to cull and donate and sell a whole heap of stuff that you've got, that you realise that, hey, we've accumulated all of this crap over the...
As long as you're not just rebuying stuff all over again.
Well, that's what tends to happen, right? You move into a new place and it's all of a sudden, no, I want new furniture and I want new rugs and bits and pieces. But no straightforward answer. And either way, it's going to cost you money. But that's just, unfortunately, I think that's just the price to play the game.
Yeah, and I think that's, the important thing to note is that either way, there's going to be a cost, and the cost is not as simply, what I'm selling versus what I'm buying for. There's either going to be an additional cost in bridging finance, there's going to be an additional cost in, storing or moving multiple times, but either way, there is going to be some level of cost if you are looking for a mechanism that is going to be able to, breach that time in between selling and purchasing. But then there's also the consideration, which is what some people do. Now, this has its own potential issues, and I'll explain that in a sec, only because one of my clients is actually a mover. But you mash the settlement days, right? So what you do is you actually match the day that you settle on both the sale and the subsequent purchase. And fantastic, right? It's like we go to one place, I sleep in one place that night, and then I move into the next place the night afterwards. One, there's an element of risk in that if settlement gets delayed on either option, potential massive issue, and great, there's penalty interest and all of that stuff.
You sleep in the truck.
Yeah, but where do you sleep? Exactly. And just the mental anguish to be able to go through that. But the other thing that can potentially act as an issue, which you do need to discuss with movers, is, okay, settlement maybe takes place in the morning on the sale, or it doesn't actually really matter. You can load all your stuff into the truck, and some movers will say, okay, we can even store it at our facility overnight, whatever it is. But then all of a sudden, settlement might get delayed, or maybe settlement doesn't happen until 3, 4, 5 o'clock. And a lot of the time, these moving companies are charging by the hour. And so, yeah, all of your stuff is in there, but you haven't settled on the purchase. So because you haven't settled on the purchase, you haven't got the keys. And because you haven't got the keys, you can't go open the door to let the movers in. And so they're sitting there with all your stuff, and there's a clock ticking away with money that's getting charged by having that sitting in the moving truck. But yeah, it can be absolutely ideal when you've got settlement days that are matching up and you can move straight out of one and straight into the other. But it does come with its own risk in that if settlement gets delayed for any reason, or if, again, you're talking about costs, the costs of, potentially the movers and that blowing out over the course of a day as well.
Ideal on paper. I think in terms of execution, if you don't have an issue with blood pressure, you definitely will by going through that experience. It makes sense on paper, and I get it, but the probability of something going wrong and it costing you money, okay, maybe in hindsight you look back at that and go, that was the cheapest option rather than moving our stuff twice, or rather than, renting a place for a year or what have you. So the angst is worth it. But in saying that, it's definitely a very stressful time. And look, if you've got a good relationship with your removalist companies, or company that you're dealing with, and maybe you can, work out a deal and say, hey, rather than doing it by the hour, we want to book out the truck and the people for 2 days and do it slowly. We'll store the stuff at your facility. So we'll pack up our existing place, before settlement on that day. We're going to sleep at our parents' house that night, and then next day we'll move into the new house. Potentially that's how it works. But definitely a good exercise in increasing your blood pressure, Andrew. No doubt about that.
Yeah. I think when you are talking about, and maybe doubling back a little bit, when you are talking about a bridging finance and you are talking about that options, you do need to really be conscious that it's a temporary solution. It's something that, is going to take you through a period of time, but you're definitely not relying on bridging finance to, go for an extended period of time. Most lenders will put the defined term as to how long that'll last for. But again, you talk about risk, you're also running the risk of, okay, maybe you've purchased a new place and haven't sold the existing property, but what happens if there's an issue with getting the purchase price that you want? Yeah. What happens if we go through an environment like we did previously where interest rates rise at a rapid rate and all of a sudden the property market panics and things, really slow down and you're no longer getting the purchase price or the sale price that you expected? The longer the time frame that you have between the sale and the purchase, the more risk that you incur. When you're buying and selling a property in the same market, that's usually an indicator that you're buying and selling property of, in a similar equivalency from a value perspective. But as that time frame expands, which bridging finance does give you the opportunity to do, then all of a sudden there could potentially be upside. You purchase the property, market moves upwards, fantastic. You get more than what you would have expected, and all of a sudden things are rosy. Maybe it happens on the opposite end of the spectrum, and the market, tanks for a period of time, and all of a sudden you're not getting what you expected. And what impact is that then going to have on your finances or your overall debt position as well?
Yeah, I mean, look, from a bridging perspective, I'd be using it to manage the small gap, as opposed to using it as an opportunity to say, hey, we can try and time the market to get a better result and stuff like that. I think that's a really bad idea. But yeah, look, there's a whole range of different things that are possible. Andrew, just pivoting a sec, in terms of purchasing and just talking through a practical element of it and saying we're upgrading and finding the money in order to do the upgrade. So just talking through something practical, but over time, and this is usually how it works, but over time, your equity position has increased, and the way that has increased is the value of your property has gone up over time, and you've chipped away at the debt at the same time frame. Obviously, those two amounts are different, but that's another story. So you look at it and go, okay, we've got a place worth $1.5 million and we owe $500,000 as an example. So we've got equity in the property, complete equity, if we take our debt up to 100%, which you can't, of $1 million.
Yep.
So you might turn around and say, okay, we're going to borrow against that, assuming that you can service. We're going to take out, say, $500,000, and we're going to use that as a deposit for our new property. Not only a deposit, but we're going to pay stamp duty with it as well too. So it's basically an equity release. So what you do is you've got an existing mortgage of $500,000, you've taken another $500,000, you've purchased a property, you've put that down as a deposit. There's some stamp duty and stuff in there, but just for the sake of the exercise, you're now paying repayments on $1 million until the new property settles. Obviously, you need to borrow the rest against that. Then you sell your original property, pay off the debt, and kind of left with whatever your debt is at the end of the day. So borrowing against your existing property, releasing equity to then purchase a new property is generally how it's done from that perspective, because you need to think, not only have we been talking about settlement and the time frame around settlement differences, but in terms of the money, the flow of money. When you purchase a property, you're putting down most of the time 10% at the time that you sign the contract, the sales contract, whereas when you sell a property, most of the time you're not getting any money until you settle. You can get early release of deposits and stuff like that, Section 27, but most of the time there's a bit of a discrepancy as well too between the flow of money. So you need to think about, how am I going to handle that? How am I going to manage that? If I don't have the cash savings to be able to do it, how do people do it? They do it through an equity release.
Or bank of mum and dad.
Well, yeah. Don't know about your parents, Andrew, but don't know if our listeners and our viewers have the bank of mum and dad to be able to tap into, but it is something that's becoming more and more common.
Becoming more and more common for people that are buying property.
Probably more so for a first purchase than the upgrade I'd suggest, but, never say never, right?
Yeah. I mean, look, it's definitely a difficult thing to be able to, navigate your way through, and which route you take a lot of the times is largely dictated not only by, what's going to be your lowest cost option, but and also the option that's going to work out best from a lifestyle perspective, but it's also what options are available for you. Engaging with your mortgage broker, engaging with your financial advisor, understanding, can I actually service this? I mean, it's all good and well to talk about bridging loans, and yep, that's, going to be something, or even talking about equity release and using that to buy and then sell. But if the bank is not going to lend you that money because you don't meet serviceability requirements, then that option's off the table, and you need to look at option, B, C, D, and E.
I thought you were going to say the option that's available to you is dependent on how strong your relationship is with your spouse. But yeah, you're right. I mean, what sounds good on paper still needs to be stress tested, I guess, because if you can't service, you might have the equity using that example that I did before, but if your income is not high enough to be able to service the debt through, say, bridging loans, then I'd hate to tell you that option's off the table anyway.
Yeah, exactly right.
Yeah, no, valid point.
Bills, I think that covers us for another episode of at least starting to unpack some of the considerations, some of the things that you can think about when you are looking at upsizing the family home. If you do have any questions, or if you do want to, get a second opinion, if that is, or if you are in that situation, details for Billy and myself are in the show notes.
Thanks, Andrew. Appreciate your time. Like, subscribe if you got something out of it, and we'll look forward to catching you on the next one.
Thank you.
Thanks for listening today. If you have any questions on what we talked about, or would like to have a chat about your money journey, visit us at 360fs.com.au. The information in this podcast is general in nature and does not take into account your personal objectives, financial situation, or needs. It is not financial, legal, or tax advice and should not be relied upon as such. You should consider whether the information is appropriate to your circumstances and seek professional advice before acting on any of the information provided. Past performance is not a reliable indicator of future performance. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of Akumin Financial Planning Pty Ltd.